Good morning, traders. It is April 23rd, about 10:24 Eastern AM Standard Time. I did want to create a video just to expose you guys to a strategy that I've been leveraging since maybe the end of last year. They're working out really, really well. I have not had any losers since I started doing this, which is why I really want to share it with you guys. If you Google it, it's called the 112 strategy. Let me see if I can Google it real quick and show you. So I just I just YouTubed trading 112, and this is how I originally learned how to do this strategy. It's by a guy by the name of Tom King Trades. He's really, really big on doing the 112. So you can't do this on everything, but this is how I learned it. So definitely take some time and review a couple of these videos. Tom King Trades is definitely the person that I lean on for this. But I've been doing it for a while, and I would say very promising, positive results from doing it. So if you look here, I think it might show you. But if you look at my trading MES, it's realized gains here, realized gains. I did a little bit on. No, this is probably from day trading, so don't worry about ES. This is playing around with day trading. But in the minis, this right here has nothing to do with it. This is me playing around with day trading, so don't count this. But this is all 112 activity. Same thing on this account. This is 112. So this has, like I said, this is very promising. I even have some unrealized going on right here. So what is 112? You could do this on anything that gives you enough credit to pay for a debit spread, basically. Which means you can't do everything because you won't have enough capital to do this trade. Now, if you look right now, I have on quite a few 112s because I've gotten a little bit insane with it because they've been working out so well. Maybe this is a good or a bad idea. Probably leaning more toward this is a bad idea to have so much capital tied up in one strategy. So time will tell. I'm not sure if this is a good idea, but the thought is, if you look at the amount of time left on the options, I'm trying to leg into them. So you see, I have one that expires in 59 days, and I have two or three that expire in 87 days, and then I got one that expires in 115. Now you're probably thinking to yourselves, like, that's a long time to be tied up in a trade. And the reason why I go out, and Tom explains this in his Tom King explains this, but you get better use of your capital if you go more to long dated options. So I typically look for things that are 90 days out and then start shopping, and then as it wings down, then I get out. So no, I am not going to stay in this trade for another 59 days. I am not going to stay in this trade another 87. I'm not going to stay for another 115. What I typically do is, I'm already getting to that point. When you put things on, you get a trade price of what of everything at the point of your entry. My goal is when the mark gets 50% of this, I will get out. So you can see already, I've pretty much locked in 50% profit for this, and I've only been in this trade for a week and a half. So yeah, I think this thing works. Now, some of the cons of this strategy, it does require, if you look over here at capital requirement, across two of my accounts, I'm leveraging $5,000, right? Which is not a whole lot in perspective. One ES future contract option to put the same strategy on will cost you $6,000 just to put on one of these 112s, which is why I'm trading the minis, because they're a fraction of the cost, and I have more diversity in my strikes to where I'm not, everything's not sitting on the same strikes. But at the end of the day, what does that mean? Like, what does it mean to do this? So let me just give you an example. So if I was to go to trade and go, maybe let's just pick one I don't have one on. So maybe let's see if I can highlight both. Let's see if I can find 66 seems like a good place. So I can go here. The 66 days. I have no trades on this one. So what you want to do first is see how much volume, how liquid this is. And as you can see here, this particular futures options are not very liquid. There's not hardly no volume in here, very little interest in this one. So you got to keep that in mind. So find ones that actually has some liquidity in them. And I'm not seeing very much. So this is a bad example. See, this one has more open interest, more liquidity. See over here, all this open interest. You know, when you see a lot of open interest, some volume, that's probably a good place to start looking. But yeah, you're not going to typically see a whole lot on the call side because most people are bullish on the market. So anyway, let me just show you. So if I go in here, let's do this one. Let me see if I can find one that doesn't have one on that far. I was hoping I have. Okay, cool. Here we go. So yeah. So let's say I go out here, and you see there's tons of open interest, right? So this is a good sign. This is a good one to put one on. So the way this works is it's the combination of a debit spread and you're selling some puts to pay for it. So what that means is you look at the bid and the ask. The first thing you want to do is look for about a 25 delta. So if I was going in this area, I'd probably go right about here, 26, 25. I'll start here and I'll pick on this is a debit spread. So you want to click the ask, right? And then you want to go about 50 wide, which is perfect, which means you see the difference between here is 50. So I will go right there. So that's going to cost me a $960 debit. Well, I'm sorry, it's going to say 960, but this is different. This is span margining pricing. So on this product, so the buying power for something like this, let's see, I'm going to get a credit. I'll get a credit of $87, and it'll hold up the buying power wise. Let's see if I can find it. But this buying effect saying credit, I'm not a good example because I have on many positions already. So this won't take up more of my buying power to do this trade. But just know this will take up some buying power. This is an IRA account. So if I change to my margin account and put this on, same thing. This is more realistic to what you guys got. You see the option buying power. It's not showing it because I got. Oh, I wish I could show you guys, but I have on so many positions already. It's not going to cost me any additional buying power. It says it's going to be $48. $48 to put this trade on, which is not a lot. So $48. So I think we figured it out. $51 to do this trade. The effect for me would be a credit because I got on other positions. So, but this it's going to take like 51 on a margin account, and then on a IRA account, probably about the same. Yeah, so $50. So that's cheap, right? $50 to put on this trade. And then you would need to pay for that. I want to pay for that. So what you do is you go up here and go around 5 delta, anywhere 5 delta. But the point is you want to make sure the bid is, I typically want like twice as much as the cost of the debit. So say this is $975. So as long as one of these 5 deltas is way more than the debit you see here, that's what you want to do. So I would probably go about right here. And we want to sell one of these. So you click on the bid. So now we have a 112 because you have one that you're buying, you have one that you're selling, that's your debit spread, and then you have one that you're selling naked because this has no protection. Your debit spread has protection, so you know exactly how much your profit is, and you have unlimited profit, and you know exactly how much your loss is. In this case, it's $241 for a loss. How much it'll debit wise will cost you here? Let's see. Here we go. This is doing it again. I can't see exact. Oh, here we go. Yeah, 245 for this one. And so, but if you layer in, well, I know what it is. Let me take that off. Okay, here we go. So again, for just the debit spread, it's $53. If you add on the naked, if you short this call, this put, now you'll see we end up with a buying effect of $240 to add on this naked. But remember, this is undefined risk, so you can put on it for 240, but based on what's going on in the market, what's the margin requirement for nakeds can vary. Not extremely much, but just know they will vary. So I would budget for a trade like this maybe $500-$600 maybe, because what you want to do is you have a 1-1. So you have one you're buying, one you're selling, and another one you're selling, which results in a debit spread, and then you have a naked put that you're shorting up here, which results in a credit. The whole point is all of it should result in a credit. So as you see here, we went from having a debit of $860 to a credit of $750. Now, if we really want to make things interesting, I do what's called a 1-1-2, which means I do one buy one, sell one, and then I click on my naked and I short two. So you end up, if you look over here on the left, you have a 1-1-2. So I have a debit spread, and then I have two naked shorts that I'm shorting up here. That results in, yes, you need more buying power for this. So you see it went from two something to almost $600. But look at all this credit. So you click it. You see now I'm going to collect 122 to tie up $524 to immediately get $122. And that's just the initial credit. And let me show you what this looks like if we, actually purchase it. So if you hit go, what that's going to mean is, let me see if this bit does it over here. Yeah, I can't analyze. Well, I think I can hit the curve and analyze. All right. So what that means is if you go and pick out this option here. So you see here, this is what we kind of picked out. I think this will do it. Not sure yet. 1-1-2. Let's minimize this. So what this does, this view is really nice. This lets you kind of see things, and we'll see how we're looking here. But let me kind of go here. So this is what it looks like. So this is the one you're buying. This is the one you're selling. So this is what's called your trap. This is a trap. So if you look at this number, these numbers up here, if you notice, no matter what I do above where you're buying, we're going to lock in $122 on this trade, regardless, no matter what it does. So if the market stays where it is right now, which is way over here, this is all profit, no matter what the market does, all the way down to 115 days from now. With this trade on, you're going to make $122. Love it. Now, if you go over here, now watch what this number does. Now, if the market starts coming against us over the next 100 days and slowly, now like I said, the key word is slow. If it slowly goes down and it becomes a bearish market, as long as it's slowly coming down, look what's going on. Look at that. So if the market goes down within our trap, so within this range of 4,900 and 4,850, if it stays anywhere in here, you see our profits actually go up. So at expiration, if the market's anywhere between here and here, look how much it goes up. It's almost doubles to like $372. Now, if you keep scrolling and we get all the way down to our two shorts, this is where you can get in trouble. If the market keeps on tanking, keeps on tanking, keeps on tanking, this is where you're losing money, and then after that, you have an infinite amount of money to lose. So I'm not saying this is not risk free, but you have a lot more scenarios where you could win money on this trade. Way more scenarios you could win money. If you really want to see how this plays out, if I go back over to where like how things kind of evolve, if you look at the analysis tab and we start playing with the theoretical date, so if we evaluate, you'll notice how the more we get towards expiration, so 77 days, and the more we get close to expiration, you're going to see this curve, this line is going to kind of start homing in, which means, we just don't want no crazy market. So see how it gets more and more, this line's moving down, 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 down. So the more this yellow, orange line moves down to where it flattens, because over time, we're locking in profits. See that? So, anywhere is profit. If we stand to the last 21 days, so even at 24 days to expiration, we still can make $122 on this trade. And if the market moved down, we still can make $300 in the trade, even down to 21 days. So if I go to 21 days, this trade still can lock in $280, $244. And the market will have to do a massive move for you to lose on this, like massive drop, like world event, turmoil and chaos, massive move against us for us to lose on this trade. Again, it'll have to drop way down. This is at 21 days. It has to drop way down to almost 41.17. So the SPY will have to drop to around 405. The SPY right now is at 504. It will have to drop 100-point drop in the SPYs for you to maybe lose on this trade. So yeah, it's a good one. I haven't in my mind figured out a way yet to lose on this thing. But it does take time for it to work, right? So make sure you're clear on that. It takes time for it to work, and you do need to use up some money to tie up for a while for it to do its job. But even with all that being said, I have a position right now that I'm locking in profits that I'm cool with. So just keep that in mind, and hopefully this makes sense. But otherwise, guys, as always, I appreciate y'all. And until next time, happy trading. Oh, just one more thing before we I end this video. One question you guys always have, which I always have too, is understanding capital requirements, getting margin calls. One thing you have to be very aware of, especially when you're doing naked option trading, is margin calls are a thing and capital requirements are a thing. And so be very aware of your buying power, and just because you have some, don't think you can tie it all up, because you're going to need it when your naked calls need requirements change to keep on the trade. And if you run out of buying power and you want to keep the trade on, and you either going to have to add way more money to your account, or you're going to have to take a losing trade. I've had that happen to me several times. So fight the urge to keep putting on. Cause even right now, I'm honestly probably too heavy on my position. I have probably way too many on right now, based on the buying requirements I have. If you click on capital requirements, you'll see what I mean. Now I have money tied up in just plain stock. So Tasty does a good job of showing you your buying power usage. I'm probably sitting too heavy on UPS and AT&T. I do agree. I have my reasons, so don't judge me. But I'm only using 6% of my account on this particular strategy. I don't have any other strategies going on right now. But I do have a lot of futures options positions right now because they're working for me. But the whole point I want to make too, like with all these positions on, which is quite a few, it's like 1, 2, 3, 4 positions on. To keep that on, I'm using up $3,902, which basically divide that by 4. That's $975 per trade. That's so. Look at it that way. You need $1,000 to do this, basically, because I got 4 and it's almost $4,000 on this account. So this is a IRA account. But if you look at the margin account, which most of you have, you see the requirements way different. Way different. Okay? So this is perfect for a lot of you that have margin accounts because you're borrowing money to do this. So IRA accounts, it's going to use up a lot more. But if you look at this account, I have on 2 of these on, and it's a fraction of the cost. So for $1,000, which makes sense, I could do double the positions because I'm borrowing half. So again, if you're just gonna put one on, $500, $600, you're good. To do 2, you need 1,000, and then you can kind of do the math from there. But I like Tasty. They really show you how you're leveraging things. 34% of my account is leveraging on this particular strategy. So, no big whoop. I'm cool. You need $1,000 to do 2. Yeah, so I just want to show y'all that to understand, so you can kind of plan for how much money you need to do the trade and all that stuff. But yeah, I mean, these things, and we recently did a huge tank in the market. That's another thing I want to make sure I point out. I was a little worried how they'll kind of perform. If you were to look at a chart, this right here was rough when things started falling for the hills. This happened on the 4th, which was the early this month. And so you mean all month with all this selling action, things went really bad. Well, it really wasn't bad. It just seemed bad, felt bad, but it really wasn't bad. But since for the positions that I had, like things were going down against me, sorta. But yeah, my buying power started going crazy because of that. So, like I said, just don't get too aggressive because you need to be able to absorb some hits on a big move on the market. Because like if you look here, we was at 5,300 in the minis for SPY. Now we're sitting at 5027. So that's quite a big move. I mean, we went from 5333 down to what we are now, which is 5099. That's 34 point move. So you gotta be able to absorb stuff like that in your strategies. I will say that 111 has held on strong in it, but it does get a little scary a little bit with the buying power and with the P&L open. I think I saw at the most. I think I saw this down instead of me being up 300, I was down like 100, right? And then I just stayed the course. I watched my deltas. So if you look here, you shouldn't have no really high deltas at all. Remember, I started at a 24, 25, area, 26 area for those debit spreads. Now they're well below that, which is not good for a debit spread. It's actually worth less now, but that's okay because all of your naked puts are going up in value, which is what. So they all kind of complement each other. If you're down on your debit spread, you're up on your naked, your 2 naked calls. Your naked puts because they're naked, and so you're locking in premium. So between the two, the difference is your profit. So okay, all right. So I'll let you guys go. I just wanted to make sure I spoke to some of that to make you understand what this strategy is. You do not have to use futures or at all. You could do this strategy on anything that you can buy a debit spread and use a naked a naked option to pay for it. That's what the goal is. It's just a lot of things don't make sense because you're not going to make enough credit to justify the purchase. So what I mean by that, if you go back to here again, and let's find a situation where I can test something out here. Let's see. All right, so I can find one I ain't got no position on, maybe here. Again, so if you look here, if I go here and say, let's just say I want to do this one. You see, have the on the here is the buy it, and then here is this 50 wide. If it let me click it. All right, so I got it behaving now. So what you want again, if you go, you're looking for about 25. Delta is perfect, so you would go to the add. So you want to buy, and so if you look, you see this number. See, it's 315. The goal is you need to pay for that. So you want to go up to the 5 delta, and you see, look at, because this is a naked. You're shorting the put, so you want to make sure this number is higher than this number. So you see here on this scenario, this no, it's not as an effective buying power. Use of your buying power, because to do this, you will have to go here maybe, right, and that will, you see, that doesn't result in a credit, and that's the problem. So you got to get like closer than you really want to get a credit to justify this, which is fine. If you're collecting 415 to what you were collecting, the result should always be a credit. And that's what I mean by that. And then that's another reason why you could do a 111, by the way. I don't typically do a 111, but you could do a 111 and you'll be fine on this trade. Again, like, you see how it's not a good use of your buying power. See, for something that's 10 days out, you're going to need more money to do the same trade if you just let more time go. So if you want something that's short term, you're trying to be greedy, you're trying to be impatient, and you want to do the strategy for something that's not that long left, then yeah, you're going to have to risk more buying power up front, tied up, because you're trying to do a trade that's you're trying to get money quick, right? So be patient with your trades. Leverage your buying power more effectively. And here's another example. You could do this on SPY, because you might be like, why don't you just do SPY? Do a you don't have to do a futures contract, just do it on SPY. Okay, let's do the same thing. Let's go about 90 days, 80 days, something like this. Let's do the same thing. So if you go down to, let's say, 20, there's 25 right here. So I'm going to click it. That gives me that. And then, of course, this is different dynamics. So let's just go maybe 5 wide. So our next round, see, 1, 2, 3, 4, 5. So something like this. See, you're going to need $80 for this trade. So we got to find something at 5 delta. So here we go. So this definitely works. So spending $80, collect 115. That should result in a credit. So click. That's a credit. But here's the problem. You see that? So even on a margin account, to do this trade, you risking $4,200 to collect $35. That don't make sense, right? I mean, you could do that, but it's not a good product to trade this strategy. There's way more effective strategy to do SPY for this. So that's the thing to keep in mind. That's because SPY is a different lot size that you're doing versus a mini or micro. So I just want to give you an example. So whatever you can find that you can trade this on, it could be Starbucks or Uber, like whatever product underlying that you like, and you got the buying power to cover effectively your strategy, you can leverage this strategy. So like I said, I like doing the mini ES. It's less capital tied up and you still get profits. So let me in the comments if you have stuff that you like to trade the strategy on that's cost effective. I would love to add that to my arsenal. And Tom King, he mentions other ones too. So there are others that you could do this on. Maybe the mini Nasdaq or Russell, the Dow, or something like that. QQQ, IWM, any of those things you could leverage it as long as you're comfortable with the buying requirements for it. All right. Until next time, guys. Happy trading. Talk to you next time.